So basically what I'm going to do is I'm going to read the question and I'm going to ask you how many of you think it's A, how many think it's B, C, D, whichever. I just want to see what you all think the answer is. Don't be afraid to be wrong. Whatever you first think, just answer it, and then I will go ahead and explain why it's not that if it's incorrect, or why it is that if it is. Okay? So the market rate of interest is higher than the stated rate of interest on bonds issued by DAX company. At what amount at what amount will the bonds be issued? Is it A, at a premium? Who thinks it's A? Okay. B, more information is needed to determine the answer. C, at an amount lower than face value. Who's got that? You've got that. D, at an amount higher than face value. Ladies, in my row in the middle, what do you think? You think it's A? You think it's A? Stephanie, what do you think? You've got C. The correct answer is C. Okay, so let's read it. The market rate. Other people are selling things. The market rate of interest is higher than the stated rate. So the market is selling it for 5%. We have a stated rate of 4%. Okay, so that's DAX company. At what amount will the bonds be issued? So if you know that everybody is selling things for 5% and this company is selling it for 4%, would you pay a premium for that? Would you pay as much as as you would for the things that are going for 5%? No. Okay, so here's another clue. At a premium and at an amount higher than face value are the same. A premium is an amount higher than the face value. Right? So if we know those two, that's out of there. So if the market rate is higher than the stated rate, then it will sell at an amount lower than face value. What's another word for that? Discount. So we're used to looking for the words discount or premium, but you have to recognize, okay, well, a premium is when it's more than the face value, a discount is when it's less than the face value. So they're trying to throw all types of vocabulary at you into one question, right? So the answer for number 1 is C, at an amount lower than face value. Any questions on that one? Okay? Watch how they ask that question. The stated rate is higher than the market rate of interest. Flips the question right around. Okay? So you just want to make sure you read it in the right order, and that's just the rules. Which statement is true concerning the accrual basis of accounting? Revenues are recognized when earned and expenses are recognized when paid. Who thinks it's A? B, revenues are recognized when earned and expenses are recognized when incurred. Who thinks it's B? We got one person for B. Revenues are recognized when received from customers and expenses are recognized when incurred. Who thinks it's C? Revenues are recognized when received from customers and expenses are recognized when paid. Who's got D? Are we just confused on this one? You've got D? I got one D, I've got one B. Okay, what is true concerning the accrual basis? Accrual basis means we recognize revenues when they are earned and expenses when they are incurred. Those are two words that we want to make sure we learn. To earn a revenue means you have completed the performed service, the service, or you've sold the product, and you have either received payment or can expect to receive it. So it's after you make the sale, after you perform a service. That's when you recognize revenue. And then you recognize expenses when they're incurred. So the month that the bill is received in, that's when we record it. The month that rent is due is when we record it. We don't just pay $1 million for rent and record it all as rent expense. If we pay $1 million and it's only $100,000 for rent each month, then we have to write it as prepaid rent, cash. So, you got me? Okay. So, which statement is true concerning the accrual basis of accounting? Revenues are recognized when earned and expenses are recognized when incurred. Why are adjusting entries necessary? Is it A, to update amounts and retained earnings for activity that occurred during the period? Who thinks it's A? Okay. B, to correct errors due to erroneous recording of journal entries. Who thinks it's B? No. C, to update accounts due to resources used, amounts expired due to passage of time, or amounts that may need to be recorded. Who thinks it's C? We've got 4 or 5 people for C. Correct. Okay. Adjusting entries are necessary to update accounts for the accounting period. So that could be, as I said, a resource we used up. If we paid cash into prepaid rent and the rent has expired for this month, we would record that as a rent expense. Okay. In a period of rising prices, which inventory method will result in the largest amount of net income? Who thinks it's Lifo? A. Who has FIFO? B. All right. Correct answer. B. FIFO. Okay. Number 5. On October 31st, Williams Company issued a $50,000 8% 6-month note to First National. Williams accrued interest at December 31st, 2015. How much will Williams credit to cash to record the payment of interest at maturity? How much will Williams credit to cash to record the payment of interest at maturity? Okay? How do we calculate that?
5,000 times 8% times 6 over 12.
Okay. 5,000 times 8% times 6 over 12. And that gives us $200. Okay. Thank you very much, Bob. Everybody understand that? Any questions on that? Okay. Number 6. At what value are inventory items reported on the balance sheet? A, at the lower of selling price or replacement cost. B, at the lower of selling price or original cost. C, at the original cost to acquire. D, at the lower of original cost or market value. Is it A? Thinks it's B. C? Does everybody says it's D? Does nobody just not know? Okay, this is the lower of cost or market rule. Lowest of cost or market. So would it be at the lower of the selling price or the replacement cost? Lower of the selling price or original cost? At the original cost to acquire, or the lower of the original cost or the market value? The lowest of cost or market rule. Okay, so it's either lower of the original cost or the market value. Okay? Seven. Which internal control is demonstrated by assigning different individuals to be responsible for related activities? Is it A, documentation procedures? B, segregation of duties? C, establishment of responsibility? Or D, independent internal verification? Who thinks it's A, documentation procedures? Okay. Who's got B? Okay, correct. B, demonstrated by assigning different individuals to be responsible for related activities. Segregation of duties. Okay. At what point in time does a company recognize an expense when it uses the allowance method of accounting for uncollectible accounts? When a customer's account is identified as being uncollectible, who thinks it's A? In the same period as the revenue is earned, who's got B? Okay. At the same time, expenses related to the collection activities are incurred. You've got C. At the time the account is written off. It's got D. Okay, it's not when we do the write-off, no. Okay, at what point in time does a company recognize an expense, okay, for uncollectible accounts using the allowance method? The answer is B. In the same period as the revenue is earned. Did anybody need to look back at 1 through 7 for the answers?
If you could go to, well, I guess I get it.
Okay, but if you do, just let me know at the end and I'll definitely go back and look at it. Okay. Respondo Company, number 9, has a $145,000 balance, an accounts receivable, and a $420 debit balance and allowance for doubtful accounts at the year end. So let me write that out right now, right? We have accounts receivable, 145, and then we have an allowance for doubtful accounts. It said 420 debit. Credit sales for the period totaled 960,000. How much is the amount of bad debt adjusting entry if an aging of accounts receivable estimates that 1.5% of its receivables will be uncollectible? Who thinks it's A? 25.95. Who's done all the math yet? Let me give you time to do the math. I'm going to do the math myself. Okay, what's the first thing we should do?
Multiply 1.5 times the 145,000.
Well, 145,000. Why not the 960,000? Okay, she's correct. We were going to multiply the 1.5%, the amount uncollectible, by 145,000, the balance in accounts receivable. Because this is the agent of accounts, reveals that we will have 1.5%, okay, of the 145,000 uncollectible. So that's 1.5 divided by 100 times 145,000. That gives me how much? 2175. Okay, so now let's make a guess at our answer. Who thinks the answer is A? B? C? D? Are we still all lost on what we're doing next? Okay, so here I go. It says, how much is the amount of bad debt adjusting entry if an agent of accounts receivable estimates that 1.5% will be uncollectible? We've determined that 1.5% is how much? So 2175 is what we assume will be uncollectible. Correct? 2175 is what we assume will be uncollectible. What credit goes in there to make that 2175? Is it A, 2595, B, 2175, C, 14,400, or D, 1755? 1755. If I have a $420 debit balance and I add 1755, what do I then do? I subtract the two, correct? Yeah. Okay. So my answer would be A. So I would say 420 of a debit. I need 2175 ending balance. So I need to say 420 plus 2175 is 2595. Okay. Any questions on that? So it says we have a 1.5% uncollectible. I multiply 1.5% by my ending balance, 145,000. Okay, that gives me the 2175 ending balance that I desire. I read back, it tells me I have a $420 debit balance, so I know it goes on the left. I know that my allowance should be a credit, so that means that my the adjusting entry is going to be the difference. So 2175 minus a 420 debit balance, I need 2595 to get it to that balance. Okay? KB Retail sold merchandise for $800 subject to credit terms of 3/10 N/30. What does 3/10 N/30 mean? Who knows?
They get the 3% within those.
Okay, so the buyer will get a 3% discount if they pay within 10 days. Otherwise, the net amount is due within 30 days. Okay? Which one of the following is part of the journal entry made by KB Retail to record the collection in full within the discount period in a perpetual inventory system? Okay? Who thinks it's A? Debit to sales discount for $24. You think so? Yeah. You think it's A? All right, we got somebody who's confident in that because he actually spoke. Wait, what? You've lost your confidence in that?
I mean, I'll go with it, but don't.
You're going with it?
Yeah, don't.
But I mean, this is the first time you spoke up. Normally you're just like, everybody's been just like, you know, hand barely up. Don't want to be wrong. This is a place to be wrong. Okay? All right. So, who thinks it's B? Debit to cash for $824. No, they're not going to pay more than what it is if they receive a discount, right? Credit to accounts receivable for $820. Well, they don't even owe $824. Or a credit to inventory for $24. Well, let's do these journal entries, right? KB sold merchandise for $800. So that means that's sales revenue, and I will record accounts receivable because it's on credit, correct? Okay, sales revenue. There's no returns. So it's all $800 that I expect to receive, okay? And they told me that I received this cash within the discount period, right? So I should receive some cash, okay? For that cash, I'm going to reduce the accounts receivable by the $800, right? Because they no longer owe it to me. And then the difference will be a debit to sales discounts. The amount that I'm discounted is 3% of 800 is 24, okay? And then the amount that's due is the difference, 776, something like that. Not important for this question, but if you want to know how to do the journal entry. Okay? So. Okay. Try to straighten that up for you guys. Okay. Number 11. Which statement is true concerning the preparation of closing entries? A. They can be prepared before or after adjusting entries. closing entries will not come before adjusting entries. They're to close everything out. What are closing entries for? B, they cause the balances of all accounts at the end of the period to be adjusted to zero. I'm sorry, no, that is not correct. They cause the balances of all temporary accounts to be, at the end of a period, to be adjusted to zero. What are your temporary accounts? Revenues and expenses are your temporary accounts. Okay, so we know it's not A, we know it's not B. Who thinks it's C? They are necessary before financial statements can be prepared. Okay, so everybody thinks it's D? They result in updating in the balance in the retained earnings for the period. The answer is D. The answer is D. Okay? If we closed out our accounts before we prepared our financial statements, and we just said that closing accounts causes all the balances of my temporary accounts. My temporary accounts are which accounts did I just say? Revenues and expenses. If I close all my accounts to zero, what will my income be? I cannot prepare my closing entries before the financial statement. So the accounting cycle is basically I go through the period, I make my recordings as they occur. At the end of a month, at the end of the period, at the end of the year, I do my adjusting entries. Once I've done my adjusting entries, I'm ready to prepare my adjusted financial statements. After that, I need to start for the next period that's coming up. That's when I close my entries. Okay? What that does is all of the income that I earned in that period gets transferred from net income into our what account? Retained earnings. Net income, retained earnings is your net income from previous years. So that's what's happening when you do the closing. I'm done with this period, I'm closing the books on it. Okay? So this 11 would be D. What does the balance in the discount on bonds payable account represent? This is a crazy question. Is it A, the additional interest costs associated with the issuance of debt? Who thinks it's A? B, a reduction of interest costs associated with the issuance of debt? B? You've got one person. C, a reduction of maturity value of the bonds. 1, 2 people. D, an increase of the maturity value of the bonds. What does the balance and the discount on bonds payable account represent? Do y'all just want the answer? Do y'all want the explanation? Okay. Quick explanation. I'll try to make it quick. Who was here for Unit 4's review? We had a 1,004.5% bond, right? Okay. Issued at $961.391. Okay. This is what's happening with a bond. For a bond, I am promising you to pay you how much money? I'm going to promise to pay you in 10 years. How much money am I going to pay you in 10 years? Which one? It's the 1 million. I am issuing a $1 million bond. I need money right now. I'll be willing to give anybody, in 10 years, I'll be willing to give anybody $1 million. I need that money. I will be willing to give you $1 million for this. However much this is, I'll give you $1 million. And I'll pay you 4.5% every year. So every year, I'm going to be doing this. How much is 4.5%? I got to take it out. Okay? Okay. Everybody else has what they say, 5%? Mark it. So you're going to give me how much money?
$961.
You're going to give me $961. Okay. So, you're going to give me $961, $391,000. Now, normally, okay, I should just get what? Cash of $1 million, pay the bond payable of $1 million. You gave me $1 million, right? So when I pay the interest, I'm paying the interest on money. How much did you give me? $1 million, right? Okay. Did I get $1 million here? Don't I still have to pay like I got the $1 million? I have to pay $45,000. Okay? All right. So this discount this amount right here is the additional cost. Because I'm going to have to pay every year. I'm going to have to give out $45,000. Okay? Every year I'm going to have to give out $45,000 based on the idea that I'm going to pay you back $1 million anyway. So I should have received $1 million in the first place. But I gave it to you at a discount. So that discount, what it represents is, you have to think about it, and this is why the journal entry looks this way, the extra additional interest. Okay? That's why that interest expense is different, is higher than the cash paid. So, what does the balance in the discount on bonds payable account represent? It's the additional interest costs associated with the issuance of debt. If it was at par value, I would have received $1 million and I would have been able to pay that 4.5% off of the $1 million I received. I received $1 million, I'm paying 4.5% of it. It's fine. I didn't receive $1 million. I still have to pay 4.5% of $1 million. Okay? I still have to pay that amount. The difference, that amount, so that discount represents that additional amount of money that I didn't receive. So that's why it is this, the additional interest cost associated. Are you all still confused? Who's still confused? Raise your hand, don't be afraid.
I'm a little confused on kind of like who's wearing the hat in the position.
Who's wearing the hat? Okay.
From the, I guess, the fund distributor or the borrower, or who's...
When I issue a bond, I'm borrowing money. So at this point in this class, we're talking about how does the company get money in. That's all we're talking about at this point. We've already talked about selling stuff and how to give discounts on that stuff. This is about when I need money. When I need money, I borrow money one of two ways: signing a promissory note or issuing a bond. When I issue a bond, I have to give it I have to say I need this much money and I'm going to pay you so much for it. Well, there's other people out here competing. Okay. So, and this is just general, if I have to pay $1 million, would I rather get 4% or 5%? You'd rather get 4% of $1 million than 5%? Right, right. If you had to pay, if you had to pay $1 million, if you had to, you have to be able to see it from both ways. So you have to be able to see it both from the issuer. Okay, if I need $1 million and I'm only given 4% versus 5%, am I going to get the full amount? No, because that's why I asked you. If you had a choice of spending your money, would you give the full amount to these people? Or would you go find somebody who's giving you 5%?
Oh, giving you 5%. I thought you said paying 5%.
We would rather, you want to pay whatever will get you your money.
Right, for sure.
If I'm going to give, because you could give a 1% and they only want to give you $300,000. Okay, what you're trying to say is I need $1 million. I'm going to give you an amount so that I'm going to pay you some interest on it. It's either going to be more or less than the market. Based on that, if the market is giving you more, you're going to pay me less. Okay, well, whatever it is, I still need to pay you back $1 million in 10 years. Okay, that's what we go off. We say, well, I'm going to give you $1 million in 10 years and I'm going to give you 4.5% of that. Okay, well, they're not going to give you that $1 million. That amount that you do not receive, that discount that you give them, is that extra cost of what you're paying. Because I don't have $1 million to pay $45,000. I only have $961,000. So that discount, so that's what they mean when they say the discount represents the additional cost.
That makes a lot of sense.
It's really a hard conceptual thing to visualize. I'm trying to think of some things where we get discounts on and how that represents an additional cost of something. But we don't, see, the problem is we don't receive discounts on anything where we're going to get money back in real life, like in a normal day-to-day. So it's very hard for us to visualize, to think about. But it's just this. I got less money than I have to pay back. Right? I got less money than I have to pay back. I'm going to have to pay back this full amount and some amount based on that amount. That discount that I'm giving you is that cost of the of the interest that I'm paying you, because I'm just not receiving that money. It's really complicated. What's
So
up?
how did you get the $38,600 for the discount?
I subtracted my bond payable from my cash from my bond payable. If I want to know how much my discount is, I just do. $10 minus 9, and then that would be $38,609. So I came up with this, and I said, okay, well, that's how much I'm not receiving.
That's for the full $1 million. Over,
What do you mean now? You're still lost on what's happening?
yeah, I am.
What's happening is you're going to pay me $1 million. Okay? I'm only going to give you $960,000. You still have to pay.
That is for the 4.5%?
Mm-hmm. For 4.5% of $1 million.
It's 45,000.
Right. Okay, so listen. You want money. This is what it is. You want money. Okay? You want $1 million, or as close to it as you can get. For that, you will pay back the person in 10 years, that $1 million. Okay? So everything you're doing is based on how much you're going to pay back. You're going to pay back $1 million. So however much interest you give them is based on how much you're going to be paying back. Whether they give you more or less money is dependent upon what the market rate is. If the market is giving everybody 5% and you're only giving 4.5%, you don't get as much money as anybody else would. Everybody else is selling the same thing for 5%. You're selling it but only 4%. So that means you're not going to get as much. So that difference is that discount. But you still have to pay that full $1 million, or the interest on the full $1 million. The extra additional that you're paying additional money because you did not receive that money in the first place. And that's what the discount is. The discount is the money that you did not receive. That's the additional interest cost. Because you did not receive that money, it's costing you more to pay that interest. Okay? Any other questions about it, we can just come back to it and I'll explain it, or if you want to go downstairs after this is over, I'll explain it again. All right? Which of the following is an advantage of the corporate form of entity? A, limited life. B, government regulation. C, ownership rights are restricted to the same shareholders. or D, ability to acquire capital? Who's got A, B, C, D? It is D. None of those are even advantages. Okay? Corporations are able to acquire capital faster than most other organizations because they are able to issue stock on the stock market, which is sellable to anybody in the world. Okay? Whereas private partnerships or proprietorships, any change in their business structure essentially changes that business altogether. At the beginning of June, assets totaled $45,600. Liabilities totaled $16,500. During the year, the assets increased by $7,000 and the stockholders' equity increased by $3,200. How much are the total liabilities at the end of June? Okay. Now, there's multiple ways to do this. I don't know which way you want to do it. The fastest way for me would say, well, my assets increased by $7,000. My stockholder equity increased by $3,200. If I have to follow the equation, how much did my liabilities increase by? $7,000 minus $3,200 is? Okay. So these increased by $3,800. All right. So now I add those up. And what's that number going to be for me? $20,300. The answer is A. Any questions on that one? Okay. I don't even have to care about what stockholders' equity is. That's for another question if they ask that one. Oh, I'm going to move this back down just a little bit. Everybody got everything on this page? Anybody still need to record anything? All good? Yes? Okay. $15. Mason Transport has the following. Cannot see. Mason Transport has the following stock outstanding at December 31st, 2015. Mason paid no dividends during 2014. During 2015, it declares $13,000 of dividends. How much of the $13,000 will preferred stockholders receive? Did I just let you all work it out and you'll tell me? Okay, when we're talking about preferred stockholders, the first thing we need to know is, are they owed for previous years? Yes or no? How do you know? Somebody says yes. Does anybody say no? How do you know? You would say yes. What would make you say yes?
Oh, no, I said no.
You would say no. Why would you say no?
Are they owed for previous years?
Yes. How do you know if stockholders will be owed money for previous years if dividends have not been declared?
Well, I think that's why if you don't declare a dividend, I don't think it carries over or...
What doesn't carry over?
Exactly.
What do you mean?
Well, if you're not distributing dividends, then you don't... Well, I don't know. Do they? I don't think so.
What does cumulative mean?
Alright.
What does cumulative mean? Okay. Cumulative means it keeps building up. Cumulative preferred stock means what? Your dividends, their dividends keep building up. Okay? So when you see cumulative, that lets you know that yes, they are owed for past years. So now the next thing is saying, okay, well, how much are they owed each year?
5%.
5% of what? Okay? There are two ways to figure out how much they're owed. It is either 5% of the $12 par times the number of shares outstanding. Okay, but if you don't have the number of shares outstanding, but you have this, and it tells you in total there's 39,600 worth of preferred stock outstanding, you can take 39,600, multiply it by 5%. That is the same thing as doing 5% times $12 par value times the number of shares outstanding. Why? Because you had to multiply your $12 par times the number of shares you have outstanding to get to 39,600. Okay? That 39,600 represents your shares outstanding at $12. So if I just multiply 5% times that amount, that is how much they are owed in dividends each year. How many years are they owed dividends for? 2 years. 2014 and 2015. Okay? So how much are they owed altogether? Everybody understand that one? How we get that? Are there any questions on how to go through that one? We're all clear? Yes? Yes? Everybody looking and saying yes? Not everybody's looking and saying yes.
Can you write it out, like how you...
Oh, sure.
Just 5% times 12
Mm-hmm.
times
No.
9.
No. You're not doing 12%. Okay, so.
The first time is 100%.
Mm-hmm.
And that gives you 1980
Mhm.
times the 2 years.
Exactly.
Oh, okay.
Okay. Right. So if it says 5% cumulative preferred stock, $12 par, and we have 39,600 in total. Okay, so yearly dividends is the 5% times, you just use 39,600. Okay?
And then you multiply that answer by 2.
And then that is right. So that's 1980, right? It's 1980, correct? Or
1980.
1980? Okay. Years old. How many years are they owed taxes for? I mean, dividends for? All right. And that'll give you the 3960. Okay. All right. So that will be 3960.
It's kind of tricky though, because if you don't multiply it by 2, you can easily just say it's
98? Yeah, you'd easily say, oh, let me just do how much I owe for the year, and that's it. That's why you want to make sure you identify, A, is it cumulative? Yes, it's cumulative. I owe them for previous years. Do I owe them for previous years? Yes, I do. How many years? First 2 steps, then you go through the math.
So they just put the $13,000 in dividends in there,
But it doesn't incorporate into the profit at all?
It does incorporate in the fact that if that number were 3,000, if that number were 3,000, then how much of the 3,000 will preferred stockholders receive? All 3,000, because it's less than the amount that they're owed. Okay?
So then if they like followed with the question asking about then how much would the common stock, you would just subtract?
Exactly.
13 divided
Right.
by 60.
Exactly. Exactly.
So it's $13,000 of dividends was for the last 2 years?
No, 13,000 is how much I declared this year.
Okay. Okay, got
So,
it. So it'd be
because these are preferred stockholders, they get and they're cumulative preferred
it didn't matter
stockholders.
how much dividends would have been last year, even if they did.
There were no dividends last year,
So,
but they are cumulative preferred stockholders, which means every year you owe me dividends.
okay.
The year that you start paying it, you owe preferred stockholders all their past dividends first. Yeah. All right. Storage Products purchased 11,000 shares of its own 75-cent par value common stock at a cost of $8 per share. The stock was originally issued at $7 per share. Which of the following is part of the journal entry to record the purchase? Credit common stock for $88,000. Who's got that? Debit treasury stock for $88,000. Credit common stock for $82.50. Debit treasury stock for $82.50. I can't be right on all of them. I can only be right on one of them. Let's figure this out. Okay, what is the journal entry for the repurchase of stock? Did everybody get this? Everybody got this? Whoever was needing it? Okay.
Repurchase the treasury stock?
Repurchase of stock is as a journal entry. What's the journal entry? Debit treasury, credit cash, in the amounts paid. So this would be a debit for how much? $88,000. Okay. When we're doing the repurchase of treasury of stock, it's just the journal entry for the amount, a debit to treasury stock, a credit to cash. Okay. Any questions on the multiple choice so far?
So what was the answer?
The answer is B. Okay. Depreciation. Ants Law, electronics purchase packaging for $600,000 on January 1st. Management estimates that the production equipment will be productive for 5 years. Its salvage value is estimated at $50,000. Compute the annual depreciation expense for 2015 and 2016 and the book value at December 31st under the straight line method and double declining balance method. All right. Who knows the formulas? You know the formula? Great. I don't. So, I need somebody to tell me. Everybody got this journal entry right here? It's on there too, so I'll bring that back up in case we need it. All right, so we need two formulas. Straight line. Straight line formula is what? Cost minus salvage value, okay, and you can look at this one two ways, times 1 over the useful life, or this divided by the useful life. It's the same formula. Okay, so this is straight line. Double declining balance. Double declining balance is what? Book value. I like that. Book value. What is book value? Book value times 2 divided by the useful life, right? And now we say here, book value is what? Cost minus, somebody said it when I was asking about this one, accumulated depreciation. Remember when we did the homework where it was like they were carrying over the number, the amount, the book value, the depreciation expense, etc., etc.? I would recommend that as your best way to keep track of things. So let's go back to reading. Compute the annual depreciation expense for 2015 and 2016 and the book value at December 31st. Okay, they want us to know the book values for both of these. All right, let me just fill this out. Cost, salvage value. Useful life. This machine costs how much?
600 grand.
600 grand. It's going to be salvageable for how much? 50. Okay, and its useful life is what? 5, 10 years? 5 years? 5 years. Cost, salvage value, useful life. I've got my straight line. Okay. Now that's a straight line. Okay. Now I need equipment. I'm going to buy it, and it's going to be worth how much? 600,000. And then I've got to record the accumulated depreciation for the equipment. Okay? So, we're going to go straight line method. And this is, I'll do this one as straight line, because we're going to have to carry the book value for both of them. And then I'll do double declining down here. Okay? So, cost minus salvage value cost me 600,000. Salvage value 50,000 times 1 over 5. 600,000 minus 50,000 is 550,000 divided by 5. 5 goes into 5, 1, 1, 0. Okay. Depreciation expense is $110,000 per year. So that means in 2015, I'll depreciate this for $110,000. 2016, I'll depreciate this for $110,000. Okay? This will be 600,000 minus 220,000. $380,000, is that what everybody else got? Any questions on straight line method? No questions? Okay. Now we're going to go double declining balance. Okay. 2016, my book value is 600,000 minus nothing. No, that is just 600,000. Okay? 2016. It's 2016 and 2017 we're doing, correct? Or 2015, 2016, I'm sorry. So this is 2015. Okay? Book value, 600,000. Times 2 divided by 5. 600,000 times 2 divided by 5 comes out to be how much?
240,000.
240,000. My accumulated depreciation is 240,000. 2016, 600,000 minus 240,000 times 2 over 5. 600,000 minus 240,000 is 360,000 times 2 over 5. So that should give you what? 140 something. There you go. Okay. Okay. So now they ask us the book value for 2016. So here we've got 144,000. It's a total of, I don't know, 384,000. $600 minus 384 is 216. I think. Is that what it is? 216,000? Okay. Any questions? No questions? Okay. Everybody got this for the depreciation? All right. Adjusting entries. Who can tell me anything about adjusting entries? Anything that has to, is there anything that's always true about adjusting entries?
Goes balance out.
That's every journal entry. Better balance out. That's journal entries in general. But just adjusting journal entries. Huh?
Assume.
Debit and credit, you mean?
Yeah.
Maybe, maybe not.
Yeah, there could be more, but.
There could be. No, this is something that's true about every single adjusting entry. What is an adjusting entry? Nobody knows? Okay, adjusting entries are entries we make at the end of a period to reflect either revenue earned or expenses incurred. Okay? We get to the end of the period and we say, oh, hey, this happened this month. That happened this month. Right? One thing that is always true about an adjusting entry, there is never cash involved. Okay? You will generally have a payable or a receivable. When you are recording revenue that you have earned but not yet collected, we're going to do a receivable. When you are recording an expense that you have incurred but have not yet paid, it's a payable. The only other thing that you will have is when you are making an adjustment from either a prepaid account to the expense or from unearned revenue to earned revenue for the period. Adjusting is just turning or is just recognizing revenues and expenses for a period. Okay? Revenue earned for the oh, can we see down there? No, we cannot. All right, adjusting entries. Okay? Revenue earned for the period, or earned for fitness center fees, but not yet billed, totaled $2,700 on November 30th. Revenues for the fitness center fees, but not yet billed. Not yet billed means we have not sent out or they have not paid us, right? Not yet billed means we can expect them to pay us. Okay? So revenue earned for fitness center fees but not yet billed. Revenue earned but not yet billed. That lets us know this should be accounts what? Thank you. Receivable. This is revenue, so this should be received. Okay? And we're going to call this fitness revenue. Okay? I earn revenue, I record a receivable. Okay? Prepare the appropriate monthly adjusting entries. We need to know this because we now have the note payable is a 9% 1-year note. The note payable is a 9% 1-year note. How do we record? How do we calculate interest expense? Interest expense for a note is what? PRT. Principal. What is our principal? Uh-huh. What is it? Oh, you don't have it. You only have the board. Who can tell me? $32,000. Yes, it states very clearly that it is just $32,000. Note payable. Okay. So note payable, $32,000. What's our interest rate? 9%. Okay. And the time is what?
1 year.
What? What? What are we doing? What are we recording? Our what? Adjusting entry, or our end of what?
Just 1 year.
End of the what? So we're doing an entire year? Kurt, are you reading it? End of the month. These are monthly adjusting entries.
I said 1/12.
1/12. This is important because, honestly, accounting gets hard but based on reading, whether you've read it or not. If I changed that and said adjustments are made every quarter, adjustments are made twice a year, adjustments are made every year, well then that's what's going to change my time on that problem. I do 32,000 times 9% times 1/12, and I end up with how much? Anybody have a calculator? $240 sounds about right. Okay. So that is what my adjusting entry will be. What's the adjusting entry going to be? I'm going to record interest expense, and what will my credit be? Okay. All these adjusting entries, as I told you, if you're recording an expense, it's generally going to be a payable involved. And that payable is interest. 240?
He said there would never be cash.
Never. No cash on an adjusting entry. You're not making an adjustment for any cash received. This is the end of the period. All I'm saying is, oh, during this month I earned this money. During this month, this expense was incurred. During this month I have to pay, I had to pay, or I had to record the interest. I had to record the light bill that I just got. I had to record the phone bill I just received. Yeah, I'll pay them all whenever I pay them, but let me just recognize that expense. Okay? Last, hopefully not least, or maybe it was least, who knows? Okay? An insurance policy was acquired on June 30th, 2015. The premium paid for 1 year at a cost of $15,000. Okay? If the premium had a cost of $15,000 and it lasts for 1 year, how much is the monthly cost?
$12.51.
Something like that? What did you do, 15,000 divided by 12? Okay, yeah. Insurance. Okay. Yes. And you got, what is it, 1250? Okay. So that means we have insurance expense. And as I said, if it's not going to be a payable account, that means this adjustment comes from a prepaid account. Okay? 1250, 1250. And you come back and write both of these in. This would be And then the insurance. Okay. Okay.
Are they normally have like a couple review sessions? Are you gonna have another one?
I will have another. It's the same work, man. I mean, it's the same question, same thing. It's going to be on Tuesday.
Okay.
Generally, if you have a test on Monday or your finals on Monday, you'll be at this one.
Yeah.
I'll be here as well. I'll be here tomorrow, 2 p.m. to 6 p.m. If you have any last minute questions, the guy just came to give me the note. You all see we have a camera back here. They tell me that all videos will be on the VLC, Virtual Learning Commons. Does everybody know how to get to the Virtual Learning Commons? If you don't, I'll take you there as soon as we're done with this. Virtual Learning Commons by the end of the day under Resources. Basically just go onto the TCC website, go to Resources, click Virtual Learning Commons, click on Resources again, and you should see it there under the Accounting Business section. I don't know yet, because they just told me that it should be there. As soon as they give me the update, I will go ahead and send it to your teachers so they can post it in your Canvas and you can have that information. Okay? So, inventory. Hanover uses a periodic inventory system. During the month of August, they sold 80 units. Determine the ending inventory and the cost of goods sold under FIFO and Lifo. Cool. Everybody have this stuff down, written down, calculated out? All right. All right. I'm going to list out that inventory. So we've got August 1st, August 5th, 11th and 23rd. $15 at 7, 15, 20, 30, 15, 20, 30, 25, 15, 20, 30, 25, 7, 8, 9, 10. Okay. And it said, ending, did it give us the ending inventory? Ending inventory is how much? Oh, they sold 80. Wow. Okay. So then total? 5, 10, 2, 4, 7, 90. Sold 80. $10 remaining. Okay. I don't know what 15 times 7 is. Anybody know? Thank you. So when I add all these up, it's a 0. 5, 13, 18, 2, 3, 4, 5, 6. $785 is the total cost. We want to know the ending inventory and the cost of goods sold. Okay? Which will be easier to account for, the ending inventory or the cost of goods sold? Who knows how to answer that question? Who would like to know how to answer that question? It's a lot easier to account. All right, Is it easier to count to 10 or is it easier to count to 80? 10. Whichever number you can count too fast, this is probably going to be the easier one to account for. Why? It's less. Okay? So, and I know that my total cost is what? My total is my sold plus my remaining, right? Okay? So if I know how much is remaining, I know how much I have in total, then I can figure out my sold. Okay, I have 10 units remaining. Let's say I am going with FIFO. FIFO, first in, first out. My 10 units, would they come from the top or from the bottom? My remaining units. My 10 units. My remaining. My 10 okay. So my 10 units that I want to account for, I would say, do I have enough here to account for my 10 units? Yes, okay. So, does everybody have a convention for going through it? Like if it was bigger than, like if it was a number like 35 or something like that? Does anybody have a way to do it? If you don't, let me go through this and then I'll try to explain it afterwards. Okay, so we'll just say 10 times, this is cost, this is units. That was confusing. So 10 times 10. 10 times 10 is 100. Okay, so for FIFO, if I have 100 remaining, I have 785 altogether. How much did I sell? 685. Everybody follow that? Okay, I have 785 in total. I accounted for what I have ending inventory. Well, if I know I have 100 remaining, I have altogether 785, then this must be 685. Okay? If I do Lifo, and I have to account for 10 units, if I have to account for 10 units, I go all the way to the beginning inventory or the beginning purchase. There are 15 units here. Will that 15 cover the 10? 15 will cover the 10. That means this entire 10 will go at a price of $7. 10 times 7, 70. So my Lifo, okay, is $70 remaining. Well, if I have 785 in total, I have $70 worth remaining, and that means the amount I sold is worth $715. Any questions? At all, feel free. Ask stupid questions if you just want to come up with a question to ask. I encourage questions at all, even if you think you know what the answer is and why it is that answer, you might hear something different. Everybody got down how to do this calculation of ending inventory or cost of goods sold? Is everybody comfortable if that were a bigger number remaining, like 30? You all would be comfortable with that? Okay, well then let me ask that question. They sold 60. What would my new numbers be? What would my new cost of goods sold, my new inventory be if this instead of being 90, 80, and 10 were 90, 60, and 30? If you all want to practice that, you can practice that. That'll be a quick, easy, extra practice that you can do right now, right here. And I'll give you the answer as soon as I calculate it.
I hate to leave, but I got another review.
That's fine. Go ahead. All right. All right. Did everybody sign in the user? Okay, cool. Thanks. Cool. Plus, and then, hey, who's got answers? I got answers. This is the case that I wanted to explain, because in this case, all of the numbers aren't smaller than your last purchase, right? Hopefully, your teacher will be nice and they'll give you a test where it's just like this, where it's just 10 here and you only got 25 and 15. It'll be smaller. But if it's not, okay, I always choose to go for the smaller of the numbers. I'm going to account for 30. Okay, and I'm going to go FIFO first. So when I go FIFO, I'm accounting for 30. This means I'm doing ending inventory. Okay? What I do, I take my amount here and I just come right here and I say, okay, well that's 30 to 25. Okay? And this is at 10. Right? So I'll say, which one is greater, 30 or 25? 30 is greater, so that means 25 comes under here. And I say, okay, well I still have 5 remaining. Okay? 25 times 10 is 250. Okay? I've done this one, right? Now I'm going to just move up. Compare it to the 30 at 9, right? So I have here 30 times 9. Which one is greater? 30 or 9, or 30 or the 5? 30? So I'm going to write 5 down here. So whichever one is the smaller is the one I bring down underneath to multiply. 5 times 9 is 45. 250 plus 45 is 295. I have no more units to account for, so I've gotten all my ending inventory. So I know that if my total is 785 and I have 295 ending, $490 cost of goods sold. Everybody see how I did that? What I do is I'm basically using 2 columns. This is where I'm going to use my ending inventory and I'm going to compare it to each of my previous purchases. If it's FIFO, I'm going to start from the bottom for ending inventory. If it's Lifo, I start from the top for ending inventory. And I'm going to say, okay, well I have 30 here and 25, which is less? 25, so let me pull it down, multiply across. Subtract here, that leaves me with 5 more units to account for. So I have 5, this was 30. Okay, well 5 is already covered, so I say 5 times 9, and that's it. Okay? Very quick convention that I came up with because I haven't seen anything else to work your way through if the amount remaining is greater than the amount that you have in one of your batches of purchases.
I'm trying to get that. It's making sense, but then so once you're here, and
Whichever one you point at is the one that goes. So you want to make sure you're also you also want to make sure you're bringing down the rate too, because this is 25 at 10. This is 30 at how much?
9.
30 at 9. Okay, so after we compare, we say okay, 30 is more than 5, so it's the 5 that goes down.
So then
That's the
so
5.
Oh,
Right.
so whichever one on the
Right, and then what we're doing here is just going straight across. 25 times 10, 5 times 9.
Oh yeah, that's easy.
Okay? Anybody has any questions if they want to try to learn this so they're comfortable, but you're not, come talk to me after this. We're in about 30 minutes. I go to lunch. And then just come talk to me or tomorrow. I will be happy to explain this little convention because it can help you out and save you a lot of time on the test. All I'm looking at is I'm saying, how much do I have remaining? 30, right? So now I'm going to go LIFO. Okay? LIFO, our ending inventory, does it come from the top or from the bottom? Comes from the top, okay? So I'm starting with this 30 comparison, and I'm comparing it from our top. 15 at 7. 15, and this was 7 each. Okay, well 30 is greater than 15, so I can only account for 15 at 7. That's 105. Well, I've accounted for 15. I need to account for 15 more. My next batch of purchases were 20 at 8 apiece. Well, now I can cover all that 15 in that 20 batch. I say 15 times 8 is 120, and then you add these up, I get 225, and that's my ending inventory. And if 225 is my ending inventory, my cost of goods sold is 785 minus 225. You say what? 560? 560. Okay? If you all want to take a picture so that you can have it to look at again, so you can look at the two different amounts, feel free.